I get a lot of questions about interest rates, and a lot of people want to know, what's going on with interest rates. Well, the Fed raised interest rates 3 times last year in 2017, the short-term interest rate. So I believe that you're still going to see that. I still believe that you're still going to see small increases, which is why in the last 2 years for our company, we refinanced almost every project we had. We did almost $400 million in real estate refinances in the last 2 years. And we were trying to get all those rates fixed. And so I think that, whether you think it's going to go up or whether you think it's not going to go up is obviously the big debate. But really, what you really should be more concerned about is try to fix your cost of debt. So what most people don't realize is debt is an expense. It's a cost. So if you go and borrow 50%, 60%, 70%, 80% against whatever it is you own, that interest rate is expensive. You're paying for the cost of that debt. It's an expense. And so if I want certainty personally, I want to know exactly what my debt is going to be from month to month to year. And on a floating program, you don't always have that choice. And so that's why we went to fixed rate debt on everything, because I do believe that rates were going up. Now, keep in mind, rates are anywhere between 4 and 4.5. That is so cheap. You gotta get out of your head that you hope that they're going to go back into the 3 range, because I don't think that that's going to happen. But you should lock now, because the rates are so cheap right now. I used to buy stuff in the 5, 6, 7% range. And again, it's just a cost of the debt. And so I'm a big proponent of understanding what your debt is. And so the questions I get is, what could happen if interest rates go up? Well, it's really simple. If you have income and you have expenses, and then that's your NOI, or net operating income. If you have debt below that, that interest rate can reduce your cash flow. So as interest rates go up, your cash flow is less. That's all it is. So if you're at a floater at 4% or 4.5% or 5%, and it goes up a half a point or a point, well, then your cash flow is going to be less. That's if, of course, your income doesn't go up and your expenses don't go up. But the point is that if you can fix that debt, no different than if you're going out and getting a bid on an insurance policy and you want to know what your annual quote is, it's the same concept. You don't want that floating up and down, because it's gonna lower your cash flow. So this happened to me personally. I have over 20 condominiums in Las Vegas that I bought over 10 years ago. And at 10 years ago, I had them all on floating rates. And over the last 6 to 8 months, the rates have been adjusting upwards. And so my cash flow on all my condos were going down. So I had a renter, let's say, paying $1,200 or $1,500 a month. And then I had my expenses. Well, if my debt's going up, my cash flow is going down. So I was seeing my cash flow just go less and less and less and less. So I went and I actually paid off all the loans, and now I'm going to put new debt back on fixed. And so that's what I'm talking about, is that you want to, if you're investing for the long term, then fix your interest rates. If you're invested for the short term, then I don't think it really matters, because if you're going to sell this year, then there's really no reason, because it's not going to happen immediately. But I think you should expect the Federal Reserve to increase rates slowly over the next year and possibly beyond, because we're still in a very, very, very good interest rate environment. Hey guys, I hope you enjoyed just one tip from my 2018 forecast for the market. If you're interested in taking a look at the other ones, just jump over to kenmcelroy.com. Thanks.